Welcome, everyone, to our webinar. I'm going to give just a minute or two for all the attendees to roll in, and then we're going to get started. All right. Hello, everyone, and welcome to Investing During an Election Year, insights from Oppenheimer's Chief Investment Strategist, John Stoltzfus. We're glad to have you here with us today. Okay, before I introduce our presenters, I have just a quick couple of housekeeping items. The first one is that this webinar is going to be recorded, so be on the lookout later today for an email containing a link to the recording and a copy of the slides. This webinar is going to run 50 minutes with 10 minutes of Q&A immediately following the presentation. So if you have any questions, please put them in the Q&A box located in your Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and the toolbar will pop. Just wanted to remind you, quick disclaimer, this is for informational purposes only and should not be construed as tax or investment advice. So we hope you get a lot out of it. And without further ado, I'm going to introduce our speakers. John Stoltzfus joined Oppenheimer as Managing Director and Chief Marketing Strategist in April 2012 from Ticonderoga Securities, LLC. A veteran of the financial services industry with over 30 years of experience in the financial markets, his work emphasizes intermarket analysis of multiple asset classes combined with global market strategies. John follows cyclical and secular trends, sectors, geopolitics, and macroeconomics. He's known for the potential opportunities his analysis provides and his clear, often witty writing and presentations to clients and financial advisors alike. He is a frequent guest on CNBC, Bloomberg Radio and TV, Reuters Television, and Yahoo Financial, among other media groups. In addition to NYU, he has lectured on global strategic outlooks at the University of South Florida and Chapman University. Maria Arriola is a partner at LSL and serves as a trusted advisor and partner to closely held business owners and their key personnel. Many of her clients came to her as growing businesses looking for advice, guidance, and collaboration beyond the traditional tax and assurance services. For over 30 years, Maria has worked alongside her clients to help them successfully navigate their growth phase while strategically planning future goals, including growing, preserving, and managing wealth, retirement planning, succession planning, and positioning their company for IPO or sale. I'd also like to give a special thank you to Sean Meyer and Steve Baden from Oppenheimer, who helped us put this webinar together for you. All right, now I'm going to hand it over to John and Maria. Take it away.
Thank you, Jill. And thank you, John, for being here with us. And thank you to OPCO. I know that Jill said I started 30 years ago. I was 5, and I'm sure, John, in the last 35, you were probably 7. So just overall, everybody should be aware of that. And Sean and Steve, thank you for doing this before I do that, and not to mention Jill and all of the hard work. So I'm just going to let John go to it, my friend.
All righty, terrific. Well, I thank you all, first of all, for being invited to this event. And also want to let you know that this hopefully will be an opportunity to give consideration to some of the things that are going on in the world of finance at this time. My bio still says over 30 years in the business. This year will actually be 41 years in the business. When I first joined,
not a good thought, John.
First came to Wall Street, it was 1983, and Paul Volcker was beginning his second term, which is a good place to start. Paul Volcker was the Federal Reserve chairman who had to battle inflation because his predecessor, a gentleman by the name of Arthur Burns, had failed to curb inflation, and the U.S. had experienced inflation that was so high in the late 70s into the early 80s that around 1982, a 10-year treasury was yielding 16%. So inflation was very, very high, double digit, much higher than it was that 10% hike, near 10% hike that we hit in 2022. And it really required draconian measures of really high interest rates to bring the economy down and then to essentially revive the economy. It was an extraordinary period. And after that, We had the period of Alan Greenspan that ran, I think that must have been 15 years. Then we got Ben Bernanke as Fed chair just around the time of the great financial crisis. And Ben Bernanke brought a new era to the Federal Reserve. The Federal Reserve essentially has a very modest, simple mandate. It's complex to achieve, of course. But what that mandate is, what their call to duty is essentially by the government is to be independent, even though it usually is a president who nominates the Fed chair. The Fed chair has to be approved by both houses of Congress, so that's an important consideration. So the independence of the Fed and its role is to provide an economy that can grow at a sustainable pace without producing high levels of inflation. And the second part of its mandate is full employment, which is defined by the Fed's mandate as around 4% unemployment, which means anywhere right now we're below that. We're in the 3% to 4% range right now in terms of unemployment. We have basically full employment is what's considered in the U.S. After Ben Bernanke, we had Janet Yellen, who today is the Secretary of the Treasury for the Biden administration. And since February of 2018, Jerome Powell has been the chair of the Federal Reserve. Jerome Powell, as you may know, if you follow the markets a lot, was behind the curve, as they say, or he sort of missed the direction of inflation early on in his tenure as Fed chair. And by 2022, we had levels of inflation that clocked in at close to 10%, about 9.8, 9.9. And he realized he had to do something about it. But in the last 2 years, the Federal Reserve has raised its benchmark rate. And that benchmark rate is called a benchmark simply because it is a rate of interest that the Federal Reserve recommends for banks to lend to each other in the overnight market that they provide member banks to the federal who belong to the Federal Reserve. They're not Federal Reserve banks. They are publicly owned banks, but they have a membership to participate in the overnight lending within the Fed to each other. And those benchmarks are tied to all kinds of interest rates, whether they influence mortgage rates, car loans, credit cards, just about everything. And because the world runs on credit. I've been through every boom, bust, and recovery cycle since 1983. I can tell you this, that generally the press, influenced by the detractors of the Fed, anytime the economy is either moving too slow and the Fed has to add liquidity or lower interest rates, or if the Fed is tightening, raising interest rates to try to slow an economy that is growing too fast and generating levels of unprudent inflation, its detractors will say the Fed is going to fail. But I can tell you this, based on the economy of the United States, the fact that we're still here all these years later as a successful country, the largest economy in the world, with China, a huge country. We've got 326 million people or so. China has 1.4 billion. We're a larger economy than they are. Somewhere around, we're about $27 million. $1 trillion, sorry. What the heck? What's a trillion? What's $1 million? It's $1 trillion on an annual basis versus their economy, probably about 15 trillion or so. So our methodology runs very well. And the Fed has been in many ways responsible for helping things out. I can remember when I started in this business, the S&P 500 was about at a level of 161. Right now, it's at a level of 5,221. And so that gives you an idea that the economy of the United States has grown as it is reflected in the largest 500 companies in the United States. So where are we today? The Federal Reserve over the last 2 years has been battling inflation. It has been successful in bringing inflation down from that near 10% level down to, depending on what measure of theirs you look at, somewhere overall between 3 and 4% inflation now, and looking to bring it down further to around a 2% rate. And where we are right now is the market is trying to judge, when will the Fed begin to cut rates? At the end of last year, the Federal Reserve, in one of its 9 scheduled meetings over the course of every year, announced that it would it intimated more than anything else, it sort of suggested that it would likely consider cutting its benchmark rate 3 times this year, which would probably equate to reducing the benchmark rate of the Federal Reserve somewhere between 0.25%, 0.5%, or 0.75%. So not a lot, but a lot when it's applied to trillions of dollars that are involved in the daily credit markets, and what that implies to economic growth. So what happened is one of the reasons why the market has rallied as well as it has since last October, late October through this year, is that those expectations that the Fed is going to cut interest rates mean that borrowing will be reduced for the consumer and for business. So it'll affect both Main Street and Elm Street, as I call where we all live, so to speak. This shows you what happens with the S&P 500 through various economic periods that are recent. This goes back to the end of 2008, which was the core of the great financial crisis, when there was a crisis related to the mortgage market that infected the real estate market, and it went through the course of the economy and required the Fed to step in, dramatically reduce rates, and it took rates down to that 0 to 0.25% level in terms of its benchmark rate. And it held it for quite a few years. And then in 2015, in December of that year, began to raise those rates again up until December of 2018. Then it paused because it thought it had raised enough. And then we ran into the pandemic, and then it cut rates again. And it was basically, it was like free money in many ways. Money was so cheap that bond issuers, companies, governments, what have you, in issuing bonds really weren't paying for the privilege of borrowing money. And people who lent money by buying bonds or buying a CD were really not getting a heck of a lot of return. And that was terrific for the stock market, because it meant that businesses could borrow cheaply, consumers could buy stuff cheaply, and it was quite an interesting period. So essentially, when we look at it, the S&P 500 is called the broad market by many people in the market. It's the 500 largest corporations in the U.S., and it's reflective of how good business is, how good employment is, its styles, is there innovation, if whether it's AI, whether it is biotechnology, developments in robotics or what have you. There's all this stuff you can see in the various sectors of the S&P 500. But you can see here, it's not up in a straight line, and it has periods of decline. Since the end of 2008, I can see here, it looks like 8 periods when the market has declined anywhere from as little as in a correction as 10.3% to as much as 33.9%. When the market fell that much in about a month's time, when it looked like COVID was just, there was no answer to COVID, and some of the smartest people in the world, and I almost want to put them in quotes, said crazy things like, it could take 40 years before we find a vaccine to battle this deadly virus. And it turned out that in short order, in about 9 months, thanks to publicly traded corporations, we were able to find vaccines that reversed that awful thing, and everything started to come back. But the process of coming back has not always been easy. The question is inflation coming back? Is the virus coming back? And that's why you can see volatility after that once again, 25% decline or 10% decline. Now, the reason why we show this is, and you can read in the download, you can read all the detail in gray. But what it shows in our view is it really, for intermediate to long-term investors, instead of trying to go in and out of the market, history has shown, and history is no guarantee of future results, but whether you look at it here from 2008 or you go all the way back to the 1950s, the reality is that, generally speaking, if you're in the market, sometimes when people get out, they get down, they get out at the low, and when they go back in, they go back in much later than from the point where the market has taken off. So what we like to say is know what you own, know why you own it, and have right-sized expectations of how your investments are going to perform during various periods of the economy. And we like, we're believers in managed, using professional managers and professional advisors to help individuals and corporations, institutional investors, and individuals to help them make their decisions based on each family's or individuals' objectives and goals and tolerance to risk. So let me go to the next slide here, if we could.
John, if I could ask you
Sure.
on our side,
Yes.
obviously we all know that on the commercial side, for sure, money is expensive right now, but yet there's still a lot of money out there to be had. If you were in the market for commercial real estate or any other, not just commercial real estate, but in the commercial world, do you think that the interest rates or the cost of lending money to someone will ease up before the end of the year, or is this whole political climate going to slow it down so that it won't be till next year?
Well, good question. And what we've noticed of late is interest rates have begun to come down, even as the Fed is on a pause. The Fed has raised rates 11 times and paused 6 times. So we're still at the rate at its highest rate that it put in at the end of 11 hikes. Then it did one pause, and then it did a hike, then it did another, then it did a pause, and now we have 5 pauses in a row for a total of 6 pauses. And the 10-year yield has actually begun to come down somewhat, as it appears there's a lot of interest in that 10-year yield from not only institutional investors, but from private investors and international investors. And as a result of that, when people buy a bond, when lots of people buy a particular bond or a particular maturity, it brings up the price of the bond and lowers the yield. So we've begun to see yields begin to ease some, but the Fed is still not through the hike cycle. But our expectations are that the Fed is likely to begin cutting rates as early as June, maybe only once before the elections, and probably after the elections, so that it doesn't feel like it's sending a political message to anybody, once or twice before the end of the year in the fourth quarter. We also think that this cycle, oftentimes the cycle, the Federal Reserve can hold rates higher for longer and push the economy into a recession. The remarkable thing is this time it has not pushed the economy into a recession, even though we've been seeing the Fed on a Fed funds hike cycle since March of 22. And part of that is a variety of things. One is innovation. Innovation has made corporations much more innovative in terms of the way they navigate tough environments. Same thing goes for the consumer. The consumer today, via all the outlets it has for shopping all kinds of things, has a greater ability to tune into competitive offerings from different places and all kinds of goods and services. But when it comes to real estate, your question, the biggest problem for commercial real estate right now really has to do with location and the type of building. And when I say location, it's always location with real estate, but particularly now, there are some cities that have difficulty getting people back to work. Sometimes that is directly related. In New York, many people are afraid of traveling on the subway which was their primary method of traveling on subway. And the problem is our local government here in New York made some distinctly wrong decisions around the police force and dealing with career criminals. As a result of that, the subway is really a problem. And a lot of people don't want to go to work. So that means office buildings are empty. There's not a lot of demand for a lot of space. But that's beginning to be offset by companies that are insisting that their employees get back in if they want to be on the fast track to promotions, et cetera. But that said, it is a problem, but it is within the real estate space. Other businesses and other locations around the country, it really depends. So I would say it like just as it is with residential real estate, location, 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 and what's the school district like, and what's it say? A lot of things apply to commercial real estate. The other thing on commercial real estate is that commercial real estate is a professional business. Real estate, residential real estate is generally, it can be a mathematic decision in terms of the mortgage or what you're selling your existing home for to get the new one. But the problem is that it's also an emotional thing. And when I bought the apartment that I live in today, one of the things that really sold me on the place, don't laugh, but it was the people had built-in speakers that were custom, what we would call in my generation stereo speakers, fabulous,
Yes.
with horns and tweeters, a big deal. And there was an arch in a beautiful arch that led to the living room, and I saw that arch and I wanted to have it, and I still have it today, and I look at it almost every day. It's that thick. It's a big, thick a work of art, a beautiful arch. But when it comes to real estate that's commercial, usually the charter that it's built around, or the what you would call the contract of it, usually takes into account an awful lot of things. Also, much of the real estate that's in trouble has been owned by the organizations that own it today for quite a few years. So they've made a lot of profits, they've written off the assets. In some cases, when you hear about an organization turning the keys over to the bank or selling it to a distressed real estate buyer, they're really just, they're going to move on. It's not the end of the story for them. So that's a long answer to a short question, but a great question.
No, thank you. It makes sense.
So what this next page is, these are the sectors of the S&P 500. The S&P 500 is comprised, depending on the particular month, because there's always companies coming in and coming out of the S&P 500. Companies can come out of the S&P 500, of course, if they get into some kind of trouble, their shares drop dramatically, but that's not usually the case. It's companies come out of the S&P 500 oftentimes if they are merged with another one, and so that name disappears. But usually, overall, there's 500 companies in the S&P 500, and they are among 11 major sectors. And the sectors are technology, all the kind of things you think about in terms of consumer technology, in terms of technology for business, hardware, software, cloudware, what have you. And then there's communication services, which is about 50 or 60% technology. And that can be a lot of your search engine companies, your streaming companies, your advertising companies, as well as traditional telephony or telephone companies that own that also own phone lines, and they do business in wireless communications and Wi-Fi, all that kind of stuff. But then there are the other sectors are more traditional. There's financials, that's banks, big banks, okay? Those names that that are the national brands, not the regional banks, but the major banks, major brokerage firms, the big names that have employees, 60, 100,000 people, although technology can have fewer in that area. And then you have industrials, which is just that. It can be everything from home appliances to defense missiles, to commercial aircraft, to equipment that is used in drilling for oil or mining for commodities to produce electronic vehicles. Then the S&P 500 contains all these. And what this chart would show you is that in this period that we outlined, which is from the end of October 27th of last year through March 14th of this year, technology was up 34% as a group. Communications was up 29.8. Financials was up 29.6. The industrials were up 26.3. And the S&P 500 was up 25.2. So in essence, those four sectors outperformed the S&P 500 and the other seven sectors. Now, within that, it's important to recognize that technology is considered to be a growth sector in general. It also has some older technology within it, but what really powers it forward is the cutting edge kind of stuff, but big companies in the cutting edge area. And it's recognized as a growth. Communication services is a mix of growth stocks, as well as the traditional telcos or telecommunications names, some of which you probably subscribe to. That's a mix of value and growth. Financials would be recognized as a cyclical sector, sensitive to the economy and changes in it. Similarly, industrials. Both you can find both growth and value, but predominantly growthier value type stocks. Growthier value, we just say, are companies that use modern innovation and technology to be more efficient, to serve their clients, their shareholders, and their employees. Consumer discretionary, which underperformed the benchmark because it was up only 23% in this period versus the returns that you see above it, is all kinds of things. It can be airlines, it can be stores that sell fashion, department stores, specialty stores, discount stores, a variety of things, hamburger joints, big national chains of hamburger joints and things like that, as well as internet sales or electronic retail stores as well. Then we have, and you can see that it was up 23%, which is still very good. Then materials is predominantly chemicals that are derived from raw materials, but it includes things like steel, and there's some gold miners in there and copper miners and things, but generally it's stuff that gets marketed to make the wheels of the economy run, whether it's in the household or whether it's in business. Real estate is just what you think of it, but it's predominantly commercial real estate. And this shows you it was up 20.1%, even as all those problems were known about selective real estate around the country. Healthcare up 17.7%. That healthcare is about 20% biotech, a large part traditional pharma or pharmaceuticals. Also includes things like other than biotech, and that would also include at least one or two big insurers within the real estate sector. Within healthcare sector. Consumer staples in the old days, this best defines it. We used to call this Coke, smokes, and soaps. It was the stuff that people can't give up. It's when there's a recession. It's really a defensive sector, as is healthcare, because when you get sick, it doesn't matter whether there's a recession or not. You got to do something about it. Okay. Consumer staples is defensive because it's you've got to go to the supermarket. Whether it's you may shop differently during a recession, but it's important. And utilities is just what it is. It's primarily electric utilities with a few water utilities, I think, thrown in. And it's considered defensive because you can't turn off the lights. You may burn fewer lights, but you're not going to turn off the lights. And energy is just what you think it is. It's traditional fossil fuel for the most part. And it was 2 years ago, it was one of the best performing sectors. It was up about 59%. But after that huge run up, it lags right now, but it looks like it's picking up as the price of oil becomes firmer. Can we go to the next slide? That would be great. Or do you have any questions, Maria?
No, we're good.
Okay, then you often hear about growth versus value, and growth, once again, is primarily technology and those companies that are dependent upon technology. And there's two types of, on a broad basis, of growth stocks within technology. They are the big established companies, those that are highly profitable, those that are deeply embedded in our lives, both in business as well as consumers. So we use these things every day. You know what your search engines are. Some people use one platform at home, a different one at the office, open architecture, closed architecture, what have you. And there's also another definition within here, and one is called long duration, and the other is basically established companies that have good cash flow and a history of profitability. Long duration technology tends to suffer, as does anything that's long duration in terms of growth within the equity space or stock space, because when companies are new, they generally they're expanding, so they need to raise capital, they need to do all kinds of funding to keep in business, while long established companies that are well run in the growth arena generally have enough cash flow. So in the case of the financial crisis, when interest rates went really low, there were technology companies that borrowed money to expand their companies or buy back shares. What happens, not because they needed to borrow money, because they had so much money on the books, it was just cheap. The big companies were borrowing for even less than 1% at one point, believe it or not. So those are considered safer to invest in during economic pullbacks, while the long duration growth stocks, those newer companies, can get hit pretty hard. What this shows is the difference between growth and value in performance this year through March 14th. In 2022, for the first year in many, value outperformed growth. And then last year, growth once again took over. This year, growth is outperforming for the most part, particularly in large cap stocks. In mid caps, it's also outperforming value, but in a total index of small caps, you look at it, it still is, and you've got real underperformance of value within the small cap area and within the Russell micro caps of those really very small companies. Now, what we've also noticed is that recently, from the beginning of February to the end of March, the middle of March this year, what we found very clearly was that value had begun to perform better. It was beginning to try to get some kind of an edge here, but still growth was outperforming. All right, if we go to the next, if we could.
So
And,
let
any
me
questions
ask you
on
though,
that?
what
Sure.
does it
Yep.
mean though? What does it mean that the value stocks are having better growth in 24? What does it matter to investors? Like, what should they be
Oh.
doing based on that?
Well, it depends. It depends upon their particular tolerance to risk and their needs for diversification. When I buy a value stock and I manage money for the firm, for example, I'm looking to diversify, so I'm not completely dependent upon growth names, which can be more volatile than value stocks, even though when times are good, growth really outperforms value. But I also want to own some value because I want greater exposure. I don't want to be all in tech. I want to own some financials. I want to own some of the more established companies and consumer staples. I might want to own some pharmaceuticals, for instance. And so that's why and I personally and professionally prefer to have a mix than be concentrated in just one area.
Well, that's the key to investing.
Yeah, I think diversification. I always say if you have a portfolio that is overall quality and it's well diversified, it's not uncommon to find some of the issues that you own are going to underperform because you're diversified. And so some stuff should be doing quite nicely. Some stuff will hold back, but your overall returns should be better than if you were just concentrated in one area and were subject to what can be the volatility that can occur in the market and can rattle investors. Now, this is the maximum annual drawdowns in the S&P 500 from 1990 through the end of 23. And what this shows you, maximum drawdown is the direction of the market in percentage terms from what the peak is in the S&P 500 in a given year to its low that year. And it varies over the course of that 1990 to 2023. The average maximum drawdown was 14.11%. It doesn't mean that the S&P 500 had to drop 14.11% every year. It was the average. So the worst was, for example, on this was a decline of 47.7% in 2008. You can see it if you look at the left there, you'll see 2008, and in red, it's 47.7%. The best year, or there's the least amount of drawdown, was in 2017 when it was 2.58%. To show you that there are all kinds of investors in that year, 2017, while some conservative investors were very happy not to see volatility, aggressive traders were very disappointed and they complained about it. But as we like to say, beware of what you wish for, because the next year the maximum drawdown was 19.78%. So what's my point of showing you this? Well, if the average drawdown was 14.11%, what was the annual price return of the S&P 500? Its performance from January to the end of December of any given year. The average in that period for all that volatility was 9.45%. Not bad. That's the average return. And when you look at it, the majority of the years were positive returns. That's those in green. And the red ones show you where the negative years. We also provide you what the average Fed funds rate was in those years. And what you'll see is that the Fed funds rate could be actually quite high, and you got a good return in 2023. It was 24.23%. And in 2022, it was only 1.66%. That was a kind of a tough year. On the other hand, when it was 0.1%, you had some good years in there, very low. But at the same time, in 2019, you had a 2.2% Fed funds rate, 28.88%. We also show you the average 10-year yield during this period and the average CPI, or consumer price index percentage, the percentage of headline inflation, which includes the inflation that's recorded in the price of food and energy. And you can see here that the average there was 2.7%. The average 10-year yield in that period was 4.24%, about where it was. Average Fed funds rate 2.78, average maximum draw on 14.11, and annual price return 9.45%. We also looked at the period of 1998 to 2023, and I'll do this as a summation. And in that period, there was greater volatility because we had three big events. We had the tech bubble of the late 1990s, 1999 to 2000, into early 2001. The average drawdown was 15.89%, but the annual price return of the S&P 500 in that period was 7.93%. Not bad. An average Fed funds rate, a little over 2%, average 10-year yield, a little bit over 3.4. So it wasn't a high yield on the 10-year that was the problem. There were other things to consider. In that period was essentially the tech bubble, the financial crisis, and the pandemic. Three major things. And yet, on average, the S&P 500 delivered positive returns. So past performance, no guarantee of future performance. But as Mark Twain used to say, history may not repeat itself, but it often rhymes. And we get our positive outlook from that. Can we go to the next chart? Next, I show you the maximum annual drawdowns. And please stick with me on this. This is in the area 1971 to 1989. This included that period when Arthur Burns failed to curb inflation, and it went up so high that the 10-year yield hit a high of 16%, or near just under 16%, 15% and change. And also includes that period when Paul Volcker had brought inflation down, and then begun to see a period of volatility inflation that was managed by Alan Greenspan. And if you look at that, the maximum drawdown was 17.56%. Not a lot different was from the other page, a bit higher, but still not a lot different. But the annual price return of the S&P 500 in that period, 8.63%, very much like the return on the other pages. So what does this tell us? This tells us that the market has been remarkably resilient during periods both of high inflation as well as in periods where inflation had been high and then began to be controlled by the Federal Reserve. So it shows that businesses and the consumer, in effect, we can draw a conclusion from this, likely are doing something to benefit from a Federal Reserve that, as long as the Federal Reserve is aware of what's happening with inflation and responds to it, even though it's not infallible, can make mistakes, over the course of a Fed funds hike cycle or a liquidity cycle where it pumps liquidity into the system, it has most certainly not failed, because the S&P 500 is a reflection of the U.S. economy, really has done remarkably well in this period. We can go to the next slide, would be great, and I'll be quicker on the next one. This just shows you the year-to-date performance, and at the beginning of the year, we came out with what has been my call for the last 12 years here at Oppenheimer. We say overweight the US, but have meaningful exposure to the international developed markets, those markets that essentially are Europe and developed Asia, as well as carving out the US and Canada, as well as the whole world, would include the US. And what this shows you is the US has 3 indices that have outperformed the developed international markets, the emerging markets, and the even somewhat less sophisticated markets to the emerging markets, the frontier markets. And it also shows that the S&P 600, the small caps, have underperformed, and so have the Russells, everything. So small caps still out of favor, though we can't help but think that as we move towards a recovery that gets pronounced in a sustainable economic recovery, we could see small caps perform quite nicely. But right now, it looks like it's large caps and mid caps with an importance to size mattering here. Next slide, please. And this shows you that the 10-year U.S. Treasury, the yield, and when you look at this, it gives you an idea of where the yield has been over the years since the end of 1965. And you can see the peak was somewhere around 80, 82 when I got into the business, and then it declined as low as below 1% in 2020, 2019, 2020, and now is coming back up, but it's not spiking. The average yield over the past 5 years of the 10-year is 2.33%. The average yield over the past 10 years is 2.34. The average yield over the past 20 years is 2.9%. The average yield over the past 30 years, 3.8. And the average yield over the past 55 years is 6.01. If you ask me where I think the 10-year Treasury yield is going, I would suggest, because we are still in a period where the Fed is working to curb inflation, the growth of inflation, we could see the 10-year Treasury trade in a range that would provide a yield of anywhere between around as low as maybe 3.8%, 3.5%, and as high as nearly 5% over the course of the end of this Fed funds hike cycle. And a lot of that just has to do with market volatility that could occur. But it's not the end of the world, and certainly at the better yields, 4% on up, offers a very, what we would say, highly complementary opportunities in fixed income to equity portfolios for the purpose of diversification. Next slide, please.
Well, but if it's expected to go down, what are your thoughts about short-term bond investments and all that? Like, is it time Is it make sense to start that? I know that it works inversely, but I didn't.
You know, right now it would be depending upon one's tolerance to risk and how much one can one's investment goals, for example. When I look at this, I would say if we could go back to that chart of the bonds, so we're not looking at gold, and I'll tell you something about gold in a second. But if we can go back to, can we go backward just one slide? That's it. Nope, the other one, if we can. We went too far. Oh, we went too far. Where was that? Yeah, there we go.
There you go.
No, the other one, the next one, it's the treasury yield. Go forward.
One more.
Yeah, there we
There
go.
you go.
Yeah, you know, when we look at this, we've got to think that as the Fed begins to get closer to a cut, and when it actually cuts, it will see the 10-year treasury yield come down, and the front end of the yield curve, which essentially is treasury bills into up to a maturity of about 2 years on treasury notes. That is directly affected by where the future is anticipating where the Fed is headed. So if the Fed is still in a hike cycle, that's why you have such attractive yields right now in the area of 5% on treasury bills. On the other hand, 10-year treasuries right now, as I recall, my screen just went out here that's in front of me. They're about somewhere between 4.3 and 4.6%, generally speaking these days. It just shows that it's expected that the Fed is going to be successful, then that the yield is still where it is right now. But I would say if someone wants to buy treasuries, my preference is to buy at the short end of the curve right now. But as we get closer to the feeling that there's going to be a cut by the Fed, then you might want to extend your maturities up to as long as 7 years. But remember, with treasuries, it's not like a company where you're looking for a management that can develop with a product and there can be a dividend yield and innovation and all kinds of things, as well as risks to all of that. But with the treasuries, you basically get, it's the bond and the interest it pays, and that's about it. So that needs to be considered. Give you an illustration. In the fourth quarter of last year, we were beginning to see this rally that was occurring, but at the same time, there was a lot of bearishness in the market. We had a portfolio that was predominantly equities that was doing very well relative to where the market was. Last year was a good year for us, but we added some treasuries. The problem is on those treasuries that we bought that were short in maturity, we're going to get 5% back on them if we don't sell them, but we got to wait all the way till till some of them the end of this year and some of them the end of next year. On the other hand,
Correct.
The equities that we owned, we've had some stocks that went up fabulous double digits, some single digits, some that didn't participate, but overall returns on a dividend portfolio that have been around double digits nicely, easily 2 times more than we got with the whatchamacallit. Did we just go offline?
No.
Okay,
We're still here. We've got
you
the
know what
gold.
happened? I just lost my screen. Okay, let's go to gold then if we can.
We got gold up right now.
We're there. We're
Let me
there.
go. Yeah, I just got to get back to the Zoom call here. There we go. So gold, you hear a lot about gold these days. And in my 40 years of experience, when there are a lot of commercials on gold on TV, by the time gold has run up so much that there's a lot of people talking very seriously about, you should be in gold. There's going to be a crisis. Whenever
The
that
info
happens,
commercial.
that's usually the time when it's too late. When gold has already made its run up. But gold, and even beyond this date, last week gold hit a record high, slightly higher than this. Well, around this 2182 high actually, and then it started pulling back somewhat. But the problem with gold is, as an investor, I'm like Warren Buffett. I don't really care for gold because it doesn't pay a dividend. It doesn't have a management. It doesn't have a product or a service that makes sense. So a lot of moving parts. It's just gold. And the traditional thumb mark, or what do you call it, the thumbnail that you would consider for this would be a maximum of 5% of a portfolio. And a portfolio that I manage, I think we have about 2% gold, and most of that is just to track gold to see how it's doing. But I think gold is terrific for a watch. If it's a good Swiss watch, one of the big names in a Rolex or a Patek Philippe or earrings or a gold chain or bracelet, but you better like it, is what I say, and it no doubt can help people cross borders in times of emergencies. But owning gold in a portfolio is not a requirement, in my view.
I
Then we
love
have
that.
Bitcoin. And here's Bitcoin. Now, when I look at Bitcoin, I don't get it. I really don't. I think that the blockchain mechanism made a lot of sense, and that it helps encrypt the direction of trades or purchases, and it keeps records and all that. But the ironic part is that whoever founded this, and a gentleman's name is attached to it, a Japanese gentleman is attached to it. It was originally created to move money around, nefarious money, drug money around the world. And then business discovered it. And then also people who needed to move money out of countries, refugee money, found a way to avoid detection of local governments, and it became more popular. And then the speculators are involved in it too. The problem is the really true believers of Bitcoin believe it could supplant regular currencies that are backed by the government. Now, while it might very well supplant the currencies of a dictatorship or a fly-by-night government, when it comes to the U.S., our currency, what really backs our currency is not precious metal or Bitcoin. It's the quality of our economy, the quality of our laws, our accountability and governance are very important, and it's why the U.S. is the currency of choice around the world, and it is, after that, generally business people will go for a euro, or they'll go with a British pound, then they'll go to a Japanese yen. But as you go down the quality chain, you start thinking about, who is this government whose currency I'm carrying in my pocket? What are their leaders like? How sound is their economy? All that kind of stuff. How cruel are they to their people? And so we're not big believers in Bitcoin. We think that, and believe me, I've been wrong at Bitcoin at 2,500. I was wrong the last time it was at 60,000. But when it fell from 60,000 to about 18,000, I looked pretty good at that time. And now recently it's rallied again. But I ask you this, just think, what if the dollar was this volatile? People would say, my gosh, this is like a frontier market. Something's wrong with America. Yet Bitcoin gets forgiven a lot. So you have to, when you talk to me, you have to realize I do not like Bitcoin. I think it's a great gamble for people who like to gamble, if that's what they like to do. But not being a gambler, who am I to say whether something is, and when I say great gamble, I mean a big gamble. So that's my comment. Now, what about U.S. trade? You always hear when a president gets into office, whether they're Republican or Democrat, okay, what they often say is, we're going to bring the jobs back to America. We're going to build everything here, or the vast majority. Well, this is the U.S. trade deficit all the way back to 1991. So you've had a bunch of Republicans, Democrats in the White House since then. And it's pretty awful. And the reason why it's bad is because in the U.S., our labor is costly relative to the labor of other countries. We have a very high level of regulation, which adds cost to all our services, as well as all our products for the most part. And while it provides, a system that, again, it's made as the reserve currency in the world, it costs competitively. And both American business and American consumers, every one of us on this call, When it comes to acting in business or as consumers, we tend to say, if it's a commoditized type product, what's cheapest? And it usually tends to be something that's foreign built. Oftentimes, much clothing is made in the emerging markets. My mother in the late 1920s and the 1930s into, I think, even the early 50s, was a seamstress and a dress designer, and she worked in the garment center in New York. The garment center in New York is now a bunch of condos and stores that sell notions and sewing, maybe textiles, but it's not where they manufacture stuff anymore. It's all manufactured in Asia and other emerging markets for cost. Most recently, during the pandemic, you couldn't find a blue mask at the peak of the pandemic in 2019. They were about $2 a piece. Finally, I went to CVS, bought 10 of them, and then I found them on the internet, imported from China. They were about 75 cents a piece. About 2 years later, they were down to about 13 cents a piece. And it was 2021, and President Biden was talking about buying American. And I thought, when I buy my next masks, I'm going to buy American. So I went online. The American mask, the exact same baby blue mask as the baby blue Wuhan mask, was $2.40. So it would have been $240 for a box of 100. For $13, I could buy a box from China. Bought the box from China. It's a reusable mask, folks.
Yeah.
And
Well,
that's
now South America countries are back. They're
Yep.
all happy.
And by the way, and this is a wonderful thing, by the way, is as a result of China because of its government emphasizing communism and generally unfriendliness towards the US, companies have really begun to diversify significantly the global supply chain, and a lot has benefited Latin America, and we believe is going to benefit Latin America more as we go forward. Already, we've seen data that shows that Mexico has regained and increased from regaining much of the business it had lost to China years ago. Its maquiladoras had suffered an awful lot when China undercut everybody around the world. But now Mexico, Brazil, and we think much more in Latin America and also in Eastern Europe, if we can see some peace there, is likely. And within Asia, it'll be both developed and emerging markets and frontier markets that are likely to do quite well as they pick up the slack that comes from diversifying away from China. And now it's time for questions from the audience, I think. Thank you,
Don,
Marie.
it looks like we only have time for one question,
Oh my
but
God.
we have one here that says, so are you saying no matter what party is in the White House, the market is going to do what it is going to do?
Oh, I'm afraid so, folks. It has generally been the case. From a historical perspective, we have seen that the stock market tends to do better over the years with the Democrats in office. But in recent years, the stock market has done about as good with either the Republicans or the Democrats in office, and it can vary. It really depends upon the economy, the level of inflation, and how well and how efficient the Federal Reserve is being managed. So ironically, it's not the only political aspect to it is who is putting the person or nominating the Fed chair. It also has to do, by the way, with fiscal stimulus, but usually fiscal stimulus is not the primary form of growth. The fiscal stimulus was a major element of growth during the pandemic because so many businesses were closed. So we would have to go ahead.
I'm sorry. There's one last question I do want to get in, even though we're about time. Will the Baltimore Bridge problem cause any larger economic problems in the United States?
Near term, it's liable to cause some problems related to the supply chain, but for all the significance of the tragedy and the loss of the lives that occurred, and the damage to that community from the loss of that bridge, well, that's put up. The wonderful thing is there's the railroad infrastructure, and that port was number 13 in ranking among the ports in the U.S. So already on day 2 after this, we're seeing reports that it's expected that the ports in the East Coast, including the ports in New York, New Jersey, are liable to pick up quite a bit of business, and other ports around the eastern seaboard into the south.
Yeah, I read that this morning too, that they're rerouting a whole bunch.
Yeah, that's part of technology, the global supply chain, and you give that a little boost with AI, and you never know. But it's today. One thing we have found is that the challenges that have been that come to the economy and to the markets are dealt with much quicker today than ever before, because both the Federal Reserve, governments, business, and the consumer are much more knowledgeable and experienced in dealing with challenges than ever before. And the information, as much as we have problems with bad information, okay, there's a lot of good information out there that really has helped us see the markets be much more resilient than they've ever been, and the economy itself.
So, John, thank you so much. So that is all we have time for. We're actually a minute over. We want to thank all of you for spending your lunch hour with us. A big thank you to John and Steve and Sean from Oppenheimer for presenting this information today, and also for our wonderful host, Maria. Appreciate all of
Thank
you
you,
coming.
John. Absolutely.
Remember, we will be sending out a link to the recording later this afternoon and a copy of the slides, so look for that in your inbox. And until next time, thank you so much, and we will see you on our next webinar. Take care and have a wonderful day. Bye-bye.